Underwriting your first commercial deal can feel overwhelming. I get it. There's new lingo, new math. Brokers are tossing around cap rates and lease structures like everyone just knows what it all means. And meanwhile, you're sitting there wondering, am I missing something? Is this actually a good deal, or am I about to screw this up? That's totally normal. When I was first getting into commercial real estate, underwriting felt like this giant, confusing black box. But here's the good news. It's not actually that complicated if you know what red flags to look for. In fact, just spotting a few key warning signs can tell you everything that you need to either dig into this deal or walk away. So in this video, I'm going to break down 5 red flags that every investor needs to watch for when underwriting a commercial deal. These are simple, they're actionable. You don't need to be a numbers whiz to understand them, just someone that wants to make smart decisions and avoid costly mistakes. Let's make this feel a lot less intimidating. Red flag number 1, the deal only works if everything goes perfectly. I call this the everything goes right deal. And you know the one. The number's almost pencil, but only if you lease the vacant suite in 30 days. And the new tenant pays top of market rent. And you cut expenses by 20%, and your contractor shows up on time and under budget. Has never happened in the history of real estate, by the way. And the bank gives you exactly the financing terms that you want. It's like stacking dominoes on a windy day. Look, I'm all for adding value. That's where upside is in commercial. But if your entire business plan requires 5 random things to go right just to break even, you're probably not buying a deal. You're buying a project full of a lot of pressure and a lot of uncertainty. And here's the kicker. That plan never goes as planned. The vacancy sits longer. The contractor misses the deadlines. The perfect tenant backs out at the last minute. And now you're behind on your debt. You're stressed out. You're wondering why this passive income feels not so passive. Let me give you an example. I had a guy reach out after buying his first retail strip center. 2 out of the 5 spaces were vacant, but he figured, hey, I'll fill them quickly and start cash flowing within 90 days. Well, 90 days turned into 7 months for him. Turns out the layout of the property wasn't that great. The parking was tight, and the previous owner had actually burned a couple of bridges with some of the local brokers. So no one was really pushing this listing. And during that time, he was bleeding cash every single month. He didn't budget for the longer lease up. He didn't stress test the deal. He just assumed everything would go according to plan. Now, he's looking to sell just to stop the bleeding. And his passive investment will likely become an active loss. That's the risk when you buy based on potential instead of reality. So here's my rule of thumb for your first deal. It needs to work as is. If you never improve the income, if you never renovate a suite, if you never raise the rent, the deal should still cover your debt and hopefully give you a little bit of margin. Upside is a bonus, definitely not a requirement. Because when you buy a deal that works today, you're giving yourself the flexibility. You got a little breathing room. You can take your time and add value strategically, not desperately. That's the kind of deal that helps you build momentum. Red flag number 2, pro forma rent assumptions with no real support. Here's a phrase you'll see in almost every single offering memorandum that you ever come across. Rents are below market, plenty of upside. Sounds great, right? Until you realize the market rents that these brokers are quoting are based on a completely different building in a completely different neighborhood with better finishes, better parking, and a better tenant mix. This is what I like to call spreadsheet fiction. A lot of brokers, not all, but a lot, will inflate future rent projections to make a deal look sweeter than it actually is. They'll slap together a rent comp sheet showing every nearby building getting $22 a square foot, even though the subject property that you're gonna buy is pulling in $14 a foot. Now, in a hot market with tight inventory and a ton of tenant demand, sure, maybe you could push rents over time. But here's the key question. What are tenants actually paying right now in buildings just like this one? Because that's what your rent should be based on. Let me give you a quick scenario. A buddy of mine was looking at a small neighborhood retail center. The offer memorandum said market rents are $25 a square foot and claimed there was 20% upside, which is ridiculous, by the way. But the current tenants were paying $18. It's a massive gap. So he did what most new investors don't do? He picked up the phone. He called 3 leasing brokers who work in that submarket. You know what they said? We're seeing rents in the $17 to $19 range, max for centers like that, and only if they're fully updated. So that $25 per square foot comp was for a newer center down the road with anchor tenants and a national coffee chain. If he had underwritten the deal using the pro forma numbers that the brokers gave him, he would have massively overpaid based on income that he would probably never collect. So here's the move. Don't underwrite to projected rents unless you've done the homework to prove them. Call brokers, talk to tenants, drive comps, and ask yourself, would I pay this rent for this space? And don't forget, even if you can push rents, how long will it take? Are tenants going to be okay with jumping from $14 to $22 overnight, even if you have the ability to do that? Probably not. Look, rent growth is great, but unless it's supported by real data, it's just a sales pitch in disguise. Base your numbers on what's real, not what's possible. The upside should be the icing. The cake, that should be the actual income that's coming in right now. Red flag number 3, you can't clearly explain your exit strategy. There's a question I ask myself on every single deal. How do I win with this property in 3 to 5 years, and what are my A, B, C through Z backup plans? If the answer isn't crystal clear, massive red flag. Because here's the truth. Money in commercial real estate is made at the exit. Sure, cash flow is great, and you certainly have to buy right on the front end. But your wealth actually gets built when you refinance, you sell, or you reposition these assets into something significantly more valuable. And if you don't have a clear path on one of those wins, you're not really investing, you're kind of just gambling. Here's another example. Let's say you're looking at a small industrial building. You plan to buy it, clean it up, lease it out, and then refinance in year 3 to pull out some equity. Sounds good, right? Typical BRRRR strategy. But here's where it starts to fall apart. What if you didn't account for how long it takes to actually stabilize the occupancy of the buildings? What if your lender won't refi unless the building hits a certain debt service coverage ratio? What if the lease terms are too short and a refinance in year 3 is off the table because lenders don't like it? Suddenly you're stuck. One of my students was about to close on a multi-tenant retail center that really did look like a win. 3 vacant suites, good location, solid price per square foot, and his plan was to fill it up pretty fast, sell it within 12 to 18 months at a higher valuation. But during one of our coaching calls, I asked him a very simple question. What kind of leases are you planning to sign with these new tenants? And he said, we'll offer, 1 to 2 year lease terms, keep it flexible so that we can fill it up really quick. And right there was the red flag. I told him, you might lease it fast, and if you're trying to cash flow for yourself, that makes all the sense in the world. But when you go to sell, what are buyers going to see? Short-term leases, no anchor, no long-term income stability. Even if it's 100% occupied, buyers might still look at it like it's 50% vacant because they know those tenants could leave tomorrow. So we redid the leasing strategy, pushed for 3 to 5 year lease terms, staggered our expirations, and added several renewal options. Took a little bit longer to fill the space, but when he went to sell, he had clean, predictable income. And buyers lined up without hesitation. That's the power of spotting red flags before they cost you time and money. So here's the lesson. Before you buy, map the exit. Literally write it out. What will make this deal more valuable in 3 to 5 years? Who is the next buyer? What kind of financing will they want? Could you sell or finance it and make more money? What has to happen in order for you to sell or refi on your terms? And if you can't come up with a clear answer, it doesn't necessarily mean that the deal's bad, but it does mean that you need to keep on digging, because a great deal without a clear exit can turn into a very expensive parking space, a glorified bank account for your capital. So before you jump in, ask yourself, how the hell do I get out? Red flag number 4, weak tenants or short-term leases. Commercial real estate is not just about the building like it is in residential. It's about the income that's actually coming in, and the income comes from tenants. So if you're underwriting a deal and the tenants look a little bit shaky, you should probably take a step back, because it doesn't matter how nice the property looks or how trendy the area is. If the rent roll is full of red flags, that building could be a liability, not an asset. So let's break that down a little bit more. You want tenants with multi-year leases, often 3 years or 5 years or longer, a real business that has been around for a while or has substantial financial backing, a history of paying on time, and ideally some skin in the game, meaning they've actually put money into their space. They've invested in their image. They want to stay. What you don't want? Month-to-month leases. Tenants who just started last quarter, or a lease that's technically in place but the tenant hasn't paid in 3 months. Here's how one of my newer students almost got caught in this. He found a cool little flex property, 4 tenants, decent cash flow, and priced below replacement cost. Looked solid on paper. But when we got into the rent roll, I noticed something. 3 of the tenants were on expired leases. So they were still paying, but technically month to month. And the one tenant with a long-term lease, they were 2 months behind on rent. That's the kind of thing that may not necessarily show up in the offering memorandum. You gotta dig for it. So I told him, look, this income looks stable, but it's not. The deal is actually lying to you. It could turn sideways very fast. Sure enough, after one quick call to the property manager, we found out that one of the tenants was planning to leave next month and hadn't even told the owner yet. The deal would have gone from cash flowing to barely break even overnight. Shorter term leases aren't always bad. They can allow you to turn over rents pretty quickly and increase the value of a property, but you have to know how to handle that. So here's the rule. Don't just look at the leases, look at the story behind them. Are these tenants actually strong businesses? Are the leases enforceable and current? Are they well written? Sometimes you'd be amazed at what is actually in this paperwork. How long is left on each lease? Do any of them expire at the same time? You want to make sure that your expirations are staggered. And if the rent roll is a ticking time bomb, or worse, just a guessing game, that's a major red flag. And one more thing, don't just rely on the seller's word for it that the tenants are great. Call them, ask questions, verify. Because once you close, you are the one that's on the hook if that income disappears. Doesn't matter what the seller told you. Strong tenants equal stable income, and stable income is what makes commercial real estate actually passive. Red flag number 5, you don't fully understand how the property actually makes money. It sounds ridiculous, I know, but this one's big. And honestly, it's the one most new investors are afraid to admit. You walk through the property, nodding along with the broker, you hear phrases like triple net lease, pass-through expenses, CPI escalations, you just kind of hope it all makes sense later. But here's the hard truth. If you can't explain how a property makes money clearly and in probably less than 2 sentences, you're not ready to buy it. Let me say that again. If you can't explain how this property makes money, you probably shouldn't buy it. Because commercial deals aren't like buying a single family rental. The value isn't based on what the house next door sold for. It's based on the income you collect every single month. So if you don't fully understand how that income is generated and protected by the lease, you're flying blind. Here's what you should be able to answer. What's the in-place net operating income? What's the actual cap rate based on the net operating income? Who pays for what? The taxes, the insurance, the common area maintenance. What are your biggest risks in year 1? And most importantly, what's the plan to protect or grow that income? I had somebody message me last year about a can't miss retail deal that they found on LoopNet, which is typically where deals go to die. But they were super excited. It was priced at a 9% cap rate and it was fully leased, which already a red flag on its own. But anyways, after 5 minutes of looking at the rent roll, I asked, did you see that 2 of the tenants are on percentage leases? They didn't even know what that meant. Turns out a huge chunk of the income was based on seasonal sales bumps that only happened 2 months a year. Once we adjusted the numbers to reflect the actual predictable income for the rest of the 10 months, that 9 cap became a 6 cap with a lot of risk. So they walked away. And I actually think that was probably the right decision. So don't be afraid to slow down and ask dumb questions. Get clarity. Because there's nothing dumb about making a smart decision and everything dumb about pretending you know something when you don't. These red flags should help you stop chasing every shiny deal in commercial real estate and start recognizing the ones that are actually worth your time. If you want a simple framework to underwrite deals with confidence, grab my free CRE deal analysis toolkit. The link is in the description below. This is the exact tool that I use to evaluate properties. What to look for, how to run the numbers, how to avoid these kinds of mistakes before they cost you a lot of money. Whether you're looking at retail, flex, or office space, doesn't matter. The toolkit will walk you through it step by step. Now that you know the red flags for underwriting, check out this video here on how to know a commercial property is actually a good deal.